Hi there, it's me, Stephen Thomas with Reports on Housing, and I'm coming to you with another housing debrief. And this week we're going to focus on, there's a weakening jobs front. And this last week we actually had a revision. It's the largest revision in history, and it actually shows that the jobs numbers have been even weaker for quite some time. And so with this weakening jobs picture, what is the overall impact on housing? And we also want to get into exactly what's going on with the data and how we got to this point where so many people are questioning the government data. And so the United States Bureau of Labor and Statistics, they're responsible for putting together the labor data that everybody relies on. And it comes out at the first Friday of each month. They report on the prior month. And they also do CPI, that's the Consumer Price Index, so they're tracking inflation. So they're doing quite a bit, and it's a government agency. We kind of see this as like all these government numbers as a utility. And this all came to a forefront earlier this year, and that was August 1st. It was Friday, August 1st. And if we go back in time, you can actually see this is the jobs report that came out on August 1st. And the jobs number, the headline jobs number was for 73,000. And this was less than expectations. But the big news were the two prior months, both May and June, they were revised down. You could see how small those little bars are. They were revised down to 250,000 jobs down. As a matter of fact, at the first weekend on Friday in September, the first Friday in September, the one number that was really low actually was revised negative. So we have actually had a slightly negative jobs print recently. And right after this jobs report came out, Friday, August 1st, it was just a few days after the Fed had made their announcement that they weren't going to do anything. The commissioner of the BLS, Erica McHantarfer, she was fired from her position as the commissioner of BLS. And and we'll get into more of her pedigree and where she comes from and all that stuff. And then this week we got where the job growth was revised down by 911,000 through March. It signaled the economy is on shakier footing than realized, and you can actually see the jobs revision. That orange line was what they originally had, and then they revised it. Now you have to understand the way that this works. They do everything on a monthly basis, and then they do a revision down the road. The revision down the road comes in at the end of August, the beginning of September, and that's the first revision, and it's pretty accurate, but they don't have all of the data yet. What they're trying to do is look at economic, in different states, the unemployment insurance claims, as well as they start to look at federal tax information as well. And they do an initial revision at the end of August, beginning of September, and then they do another revision the following February. And by then, that's like a year later, everything is totally dialed in because they have all this information that they collect. And it's very transparent, the entire process that they do. And you can actually see that this revision was bigger than the revision in 2009 during the Great Recession. And typically we get it's even a bigger revision when we're at an inflection point, when there's a big gigantic change in the direction of employment. And with this big revision, the Labor Department watchdog came out and they said that they're going to be opening up a probe for the BLS. And so basically it's the Inspector General. They oversee the Labor Department office, and they will be conducting an investigation and really trying to assist the Bureau of Labor and Statistics in more accurate data. And this is the official letter that came out telling them that we're going to help you out a little bit because these revisions are a bit scary is kind of what they're coming down to. And everybody has this big sentiment right now across the United States that the data is broken. I too have had lots of phone calls, text messages, questions in various presentations, all centered around data. And I want everybody to know that this is not a political thing, yet it was turned into a political thing. And it's when you have one person that comes out and starts talking about the data is bogus, it kind of like catches from there, and pretty much everybody starts talking about it until the sentiment overall is that the data is definitely bogus and needs to be fixed. But as far as the data is concerned, I'm going to come at this from an economist's point of view. And as far as the government data across the United States, I was saying that it's a utility because everybody can trust it. Around the world, the United States data that we put together is considered the gold standard compared to what all these other governments are putting together. Compare what we put together to like some China or Russia or even Europe. We are the gold standard. We are highly transparent and easily accessible. I can go to any of these different branches and actually download Excel data. They talk about how they collect the data. They talk about why there's revisions, all the different things that they do, the nuances. They're just a bunch of nerds. And at the end of the day, all these organizations are run by a bunch of geeky nerds like myself who absolutely love data enough that they'll talk about data to their loved ones. They'll talk about it at lunch and dinner. They'll listen to podcasts. They'll read everything they can about what's going on with numbers and statistics. That's what we do because we love it so much. And it's all about data integrity at the end of the day. Everybody wants it to be as neat as a pin, and so that everybody can take a look at it with a bow on it and say, hey, you know what? They did a really good job. This is why there were errors. We fixed them all, and that type of thing. Now, as far as Erica is concerned, she was fired from her position. She actually has this very long pedigree that she was the commissioner of the BLS, but she was also a lead economist, labor market center for economic studies at the Census Bureau. And she was a senior economist, council of economic advisor to the White House. That is a nonpartisan, economic think tank that helps out the president of the United States. And there's a number of other things. There's their U.S. Department of Treasury, and also, once again, working for the census. So she has this long pedigree, and it got me thinking. I remember a whole bunch of committees that were dissolved, and they were dissolved earlier this year, and not with a lot of fanfare, but us economists, we all knew it and said, what are you doing to our data? Why are you playing around with the data? And we like the way things are, and these different committees actually don't cost anything. There are a lot of people put on it that want to help out. On February 20th of this year, the Commerce Secretary disbanded the Bureau of Labor Statistics Data Users Advisory Committee, the DUAC, and they provide advice to the Bureau of Labor Statistics, that's who puts together the labor reports, from the points of view of data users from various sectors of the United States economy. So they're saying, yeah, you know what, you can fix this, you could do this, you could do that. And also on February 20th, the Commerce Secretary disbanded the Bureau of Labor Statistics Technical Advisory Committee, TAC. And TAC is an advisory body composed of 16 experts in economics, statistics, and survey designs that provides advice to the commissioner of the BLS on the technical soundness and relevance of BLS data research and statistical methods. So a bunch of geeks are helping them make the data better. And the reason for the disbanding was their purpose has been fulfilled. The experts who served out on the panels who were unpaid noted that the cost of the committee was minimal. So, which is weird that their purpose had been fulfilled, but later on, a few months later, we don't like the data. So on February 28th, the Commerce Department also terminated the Federal Economic Statistics Advisory Committee. They're called FESAC. The FESAC advises the Bureau of Economic Analysis, the Census Bureau, and the Bureau of Labor and Statistics, who puts together these labor reports on statistical methodology and other technical matters. And then also the Commerce Department terminated the Bureau of Economic Analysis Advisory Committee at the same time. And they help out the BEA. But it's just these 4 different committees were disbanded, and they were all given the same reason, that their purpose has been fulfilled, that they were the gold standard, that they did a great job and everything was good, and the experts that served on it weren't really paid. So at the end of the day, I was scratching my head when it happened. A lot of economists were going, why are they doing this? Makes no sense. And then we had the termination of Erica. Now, as far as the BLS is concerned, they rely on surveys, and the response rate has been going down into the gutter. You can actually see there are tons and tons of, they survey about a third of the country, or right around there, and you could see that the statistics response rate was about, in the 60s back in 2017, 2016, 2015. And then since then, after COVID, has plummeted down to 43%. So there's a lot of holes in the data. When there are holes as big as this, then we get into more of estimating where things need to be. And they say that it's an estimate. Now, these holes mean that they have to try to fill these holes with computer models that they've come up with. And it's based upon past data and things like that. Well, the data gets more wonky the more holes that you fill, and which means that the error rate is higher, which means that there's going to be larger revisions. And the larger revisions come when the economy is at an inflection point, kind of like it is right now, where we're seeing a slowdown in labor. And so this is really just an estimate. And when if you're off by 100,000 jobs in a jobs report for a month, there's 163.4 million jobs that are out there. So 100,000 out of the 163.4 million comes out to 0.06%. That you're off by. That's not that big of an error. So even though it seems big in the scope of things when we're looking at each of these points, from economists' point of view, this isn't that large. It's large compared to where they've been in the past, and that is how much of a gold standard the United States has been. But the issue really is not that they're not transparent or they're doing anything political. It's that the methodology of getting these surveys back, it's not working. So we have to move to another place, and that's kind of what everybody's looking for right now. So that's what we kind of need to fix. But we need these different committees to help out in these fixes that we're talking about. We just can't arbitrarily stick somebody in there, because we're going to start to erode the public trust in the data, and that utility that we use isn't going to be as great if we just stick anybody into these roles. If we stick anybody into these roles, we're going to wonder, what are they doing? And this data doesn't seem right. And then we're going to have to not go to this utility where you can download it all. We're going to have to go to the private sector. And now there's going to be an appetite for the private sector to make this stuff, but it will be at a cost. I will no longer be able to download these for free. I'd have to go to these different agencies that are out there that are in the private sector and download or get a subscription that will cost money, and our economics data will no longer be the gold standard. That is not the direction that we want to go with. So now I'm going to get off my soapbox. The only reason why I do that is because I'm an economist, and at the end of the day, when enough people are talking about the way that you can't trust the data or anything like that, that is just not true. They're extremely transparent. Every time they make a correction, they explain why, and all the data, they have additional data. And finally, by the time that they do these final revisions a year later, the data's all locked in, but we want the data on a monthly basis, and we'll figure out a way of making the data more accurate going forward on a monthly basis. So as far as the jobs picture is concerned, it is really slowing down. And when it slows down like this, it's kind of a red flag. But when anything in the economy slows down, what happens is there's no longer this, even though there's been an appetite on Wall Street, there's not as big of an appetite on Wall Street, and people all these investors want to move their focus to longer term issuance. And that is what ends up happening when it slows down, is you get people that want to invest in 10-year treasuries as well as mortgage-backed securities. And as a result, when the economy slows down, they move their stuff into the safe haven of mortgage-backed securities, you see that interest rates fall. And that is exactly what has already happened. And if you look at this, you could see that interest rates right now are hovering around the lowest levels of the year. We were above 7% earlier in this year. We started off the year above 7%, even hit 7.25%. We're now at right around 6.25%, and it's the lowest level since the very start of October of last year. And we're a week before the Fed meets when we're recording this on September 12th. And this week before is exactly where last year we were at 6.1%, but is arguably too low. This time, 6.29%, where the economy's at, feels right. And which means that we're not going to all of a sudden see the interest rates go up for the remainder of the year. That's most likely what we're going to see is it continue to float closer and closer towards 6%. And what happens the closer we get to 6% is we're already seeing it in many markets. We're seeing demand start to pick up. The closer we get to 6% and the lower rates go, the more demand enters the system. And that's because there's been many years where millennials and Gen Zs have been passed up and not able to purchase. And one of the biggest issues is that they were fighting against the Generation X as well as baby boomers, and they couldn't win during COVID because there weren't enough properties on the market. And when you had 10 offers, the first-time home buyers didn't win as often. So, and then after that, we had rates that went up and affordability rose. And with home affordability finally improving, these millennials and Gen Zs can finally enter into the marketplace. There's about 4 million of them sitting out there. And usually we don't say there's a lot of pent-up buyer demand, but there really is pent-up buyer demand. And at the end of the day, we'll see that resurgence in demand as interest rates and home affordability improve. And what we're seeing is that we've already peaked in most markets. And the peaks are coming earlier than they have the last couple of years because there's been enough broadcast out there that the United States housing market is a lot slower than it's been over the last couple of years. So not as many people are playing and fewer homeowners are placing their homes on the market. Pending sales activity is starting to rise and inventories are dropping. If you have demand levels that are flat or rising and you have inventory levels that are falling, the market's actually heating up in many markets across the United States and many markets that we're tracking as well. So that's the story right now. And that's what will continue to happen as rates fall. We'll see an improvement, and you can actually get towards the end of the year, we can actually get a market that gets hotter from week to week if interest rates remain where they are or even go lower. So if you like this video, you know what? Like it. Subscribe to our channel. Go to reportsonhousing.com for more information. We have many reports throughout SoCal, the Bay Area, Phoenix, and Vegas. And our most recent report is called The Stretched Dollar. And you could utilize the coupon code JOBS for a free month. And you know what? Subscribe to our reports. It's going to make a difference for your business. Even if you're a buyer or seller, we have plenty of buyers and sellers out there, and they swear by it. They say this is exactly what we're experiencing within the marketplace is what you're talking about. So, and we don't lie about the data, and we're not hoping for any one specific thing. We're trying to properly set people's expectations based upon the data that's coming in. So, like our channel. Subscribe to our channel, like this. We appreciate it. And you know what? I thank you for tuning in to another Housing Debrief. I hope you have a wonderful weekend, and we will see you on the other side.